everyone. We are going to go over a practice exam for exam 3 to help you guys prepare for the next exam. I'm just going to share the screen. All right, so first, what are the advantages of budgeting? And this answer is going to be D, all of the above. Budgeting is the projection of revenue over a period of time. So it's going to basically, it's going to help the management get out of doing things the same way. It also can be used for performance evaluation, and it unifies the efforts of various departments. And 2, what is the original starting point that determines the levels of all budgets? That is A, forecasted sales levels. It's because those estimate the quantity of goods and services over the period. So it's going to start and help determine the rest of them. Byron Products has a favorable materials price variance. Which of the following would be the least likely for this variance? That answer is going to be C. The company's employees are more efficient with the use of the production time. So when it's favorable, it's when the standard price is higher than the actual. So if there's going to be less money, that if less money was spent, basically the time doesn't deal with the materials. Dabney Inc. has a favorable direct labor efficiency variance. Which of the following is least or is most likely reason for this variance? That is going to be B. So the amount of time relates to the work labor. So it's when they took a shorter amount of time to produce the product than expected. And then 5, the difference between split costs and actual costs for direct materials. That is going to be the materials price variance. So split cost shares the price among different departments, where the actual cost is the amount paid to acquire the product or asset. So the price variance is going to be the actual versus the budget, so it tells if you're overpaying or not. And then 6, the sum of direct labor rate and efficiency variances is equal to the flexible budget variance. That's just a formula. Then for 7, the amount of direct materials purchased is usually equal to the amount of direct materials used in production. That is false. So companies purchase more or less than what is actually used in production from time to time. So that's why it's not going to be true. It's not always going to be the same. Direct materials price variance is unfavorable if the price paid per unit is greater than the standard price per unit. That is going to be true, and that's just a definition. And then 9, a negative direct labor variance, efficiency variance is considered favorable. That is also true. That's favorable because the direct labor cost is less than the standard cost and labor is working the way that it should. Which of the following managers would be most concerned about a segment's ROI, its return on investment? And that is going to be C, the investment center manager, because that manager deals with all the investments and the ratio of net income to investments. So they're going to be the ones dealing with it. 11, strategic planning is essentially a form of short-range decision-making regarding the day-to-day operations. That is going to be false. So the strategic plan outlines the decisions of all the allocations, and the priorities and actions are set by the board. So it's like an extended time, so it's not the day-to-day operations. 12, on the budgeted statement of cash flows, cash receipts from customers are generally equal to the budgeted level of sales. That's going to be false. So the budgeted cash flows consist of cash, credit sales, and not equal to the budgeted level of sales if only cash sales are equal there. Which of the following statements regarding the structure decentralized organizations is false? So it's going to be D, decision-making authority rests solely with the top level of management. This is D because senior management actually in decentralized organizations, they shift authority for most decisions to the lower levels of the organization. So it doesn't rely solely on the top manager. Which of the following areas is not a category on the balanced scorecard? That is going to be D, internal strategy development. That's just definition. 15, the time value of money dictates that money received today will be worth blank in the future than it is worth today. And that is going to be more. So the money received today will be worth more in the future than it is today. The cash payback period is the number of years needed on an investment for the after-tax cash flows to equal the original investment. That's just a definition. That's C. 17, the hurdle rate is the minimum rate of return that a company expects to receive from any investment that they undertake. It's true. Also just a definition. 18, a budget used to plan for the acquisition of long-term assets is called a capital budgeting. That's also just going to be a definition. And then 19, which of the following is an advantage of decentralization? So it allows to make decisions in a more timely manner. So let's see. So it eases, since basically it's not all on the top management, it's more spaced out. So there's greater time management. Then 20, refer to, Pennington Products has two product lines, R100 and R200. Revenue and cost information for each of the product lines are as follows. It gives you the selling price, the variable cost, and the fixed expenses. Last year, the company produced and sold 30,000 units of R100 and 20,000 units of R200. Refer to the Pennington Products information above. What is the segment margin of the R100 product line? So to find this, you are going to take, since we're looking for R100, that's this right here, you're going to take the selling price, which is 45, and you are going to subtract the variable cost, which is 15. And then you're going to multiply that by the amount of units sold. So that's 30,000. That 30,000 is right there for R100. And then you are going to subtract the fixed expenses of 250,000. And then that is going to get you 650, which is choice A. And then refer to the Pennington Products information above. If the total fixed expenses is 850, what is the common fixed expense? So to figure out this, you are going to add both fixed expenses together. So that's the 360 and the 250. So 360 plus 250, that gives you 610. And then you're going to take this 850 that's given in the question and subtract out your 610, and that is going to give you 240, which is going to be your common fixed expense. And 22, which type of manager would be allowed to decide whether or not the new manufacturing equipment would be purchased? That is going to be the investment center manager. And this is because the manager, one of their responsibilities is to make all the investment decisions and return what's expected on the investments. So putting an investment into a new manufacturing equipment is going to go through the investment center manager. Findlay Company has its company headquarters based in Raleigh, North Carolina, and has 6 individual retail stores spread throughout North Carolina and Virginia. Which of the following costs would most likely be treated as a common cost for segmented reporting purposes? This is going to be C, lease costs for the company headquarters. So common costs are not traceable, and leases and rents need to be paid whether it's divisions or 2 or 3. So a common cost are costs incurred whether a division operates or not. So that's why a lease and a rent is always going to occur no matter if it splits up into 7 divisions or if it stays whole. So that's going to be the common cost. All right, so now for the short answer, Fine Furniture manufactures wooden tables. Management is preparing the budgets for June and has accumulated the following information. So expected June sales in units of 2,000. Expected July sales in units of 2,500, the selling price of 250, and the direct materials of 40. So for this, I'm just going to set up a little table here. It's a little bigger. So we're going to take the expected sales in units, selling price per unit, and total revenue. Right, so we're going to start with the 2,000 right here. The selling price per unit is 250. So your total revenue is 500,000. Pretty simple. And now for B, fine furniture does not have a work in process inventory since all the units started to complete on the same day. The ending finished goods inventory is maintained at 5% of the expected sales for the next period. Prepare the production budget of the tables for the month of June. So it's going to do a table just like an A. It's going to be a little bit longer this time. Budgeted beginning inventory, expected sales next period, budgeted ending inventory. Just move this over just a tiny bit. Oh. And then production. Well, basically the ending budget. So we're at that. So the expected sales, we start with 2,000. The beginning inventory is going to be 2,000 times the 5%, which gives you 100. And that 5% is from right up here. And then the expected sales next period is the 2,500. And that comes from, so this 2,000 is for June, for the next period is for July is 2,500. So that's what those come from. The budgeting ending inventory is the 2,500 times the 5%. Here. So that amount is going to be the 125. And then to find this budget, I'm just going to do it right down here. So this amount right here that's would normally go right here is 2025. But to calculate that number, you take your budgeted ending inventory and you add in the expected sales in units. And then you subtract out the budgeted beginning inventory. So you're going to take 125 plus 2,000 minus 100. That's going to give you your 2025. And so that's for B. And then for the last part of this question, you need to find like the total needed. So after that, we're going to take the budgeted production, the direct materials per unit of lumber, cost per unit, and then to find the total needed. So that was just, the first part was just the first part, and then this one is going to be to find the actual budget. So this is 2025 is what we found. The direct materials is going to be 40, which is shown right up here. And then the cost per unit is 0.5. And that 0.5 comes from right here. So the total needed, which is going to complete your production budget, is going to be 40,500. And this is calculated just by taking the 2025, multiply it by the 40, and then multiply it by 0.5. That gives you 40,500. So that is all of B. And then for C, Fine Furniture is located near a lumber supply store, only purchases materials as they are needed in production. They do not carry a materials inventory. The company has an agreement to pay their suppliers 60% of the cost of purchases in the period bought and the remainder of the period following. The accounts payable balance at the beginning of June is $30,000. What is the amount budgeted to be paid for June for direct materials? So to find this, you're going to take the amount paid for this period and you're going to use the 60%. So to find this, you're going to take the 4,500, which you just found from B, the production, and then you're going to multiply it by 0.6 for 60%. That gives you 24,300. And then the amount paid last period is given with that 30,000 in the question because it's asking for the June, so it's going to be right there. Last period. And then for the total paid, you're just going to add these up, which gives you 54,300. And that's your answer. So you're all set for problem 1. Now if we go to problem 2, Fowler Company manufactures titanium molds and uses standard costs to account for their production line results. Standard costs and quantities are listed below, gives you the direct materials, direct labor. Annual costs and quantities are listed below, direct materials, direct labor, actual production, and sales. So first, the amount of direct material price variance, and then you have to find out if it's favorable or unfavorable. So you're going to take the direct material actual cost, and that's going to be 315,000. Just found right here. And then the direct materials split costs is going to be, you're going to take the 6 kilogram, you're going to multiply it by 50,000. So those numbers, 6 comes from right here, 50,000 comes from right here. That's going to give you 300,000. So then the price variance DM is going to be 315 minus 300. So the actual minus the split, and that is going to give you 15,000. This is unfavorable because the actual cost is higher. B, the direct material efficiency variance. So first, you start with the direct materials split costs. You take 6, but you have to use 51,000 this time, which comes from this because this is actually what's going to actually used in production, and use that for efficiency. That gives you 306. Then you take the direct materials standard cost, which is the 110, which that 110 is going to be the actual production times the standard quantity. So this actual production times the quantity. That. And then you're going to multiply that by 5 and then by 6. And that's going to be both of these for right here, 5 kiloliters and then 6 for kilogram. And that amount is going to be 330. So your direct materials efficiency variance equals the 306 minus the 330. That's going to get you a negative 24,000. And that's going to be favorable. And it's favorable. Oh, don't know what just happened there. Okay, so it's favorable because the standard is higher. Okay, so the direct labor rate variance is going to be, so first you look at the actual cost. That's going to be 800,000, which is shown right here. And for the standard cost, it's 12 per hour times 6 hours spent times 6,500 hours. Those all come from, the 12 and 6 come from right here, and the 65,000 comes from right there. So that's going to give you 780,000. And then the direct labor rate variance is the actual minus the split equals 780 equals 20,000. Unfavorable because actual is higher. And then for the direct labor efficiency variance, a little bit, you take the split minus your standard. So to find this, you already found your split. Split is the 780,000. And then your standard is going to be your amount of, or the actual production, and then multiply that by out of hours. So with the split and the standard is found with the 792, just found up here. The standard is the 12 times the 6 times the 11,000. That's going to give you the 792. And then that is what you take the 780 minus 792, and you get the 12,000 favorable because the standard is higher. Okay. So that's all for question 2. And then for problem 3, the investment center performance. So Thomas has a division that generated 5 million in sales and operating income of 1 million on average operating assets of 2.8 million. The company's management team expects division managers to generate sufficient income to guarantee a minimum return of 15%. So this one's pretty simpler, just formula. So to find the residual income, you're going to take the net OI minus your average operating assets times the minimum required rate of return. So that is going to be 1 million minus 2.8 million times 0.15. Those numbers are right in the question. The 1 million gives you the operating income right here. Average operating assets 2.8. Minimum rate of return is 15%. So that's all given, very simple. So that gives you $580,000. And then the division's return on investment is the net operating income divided by average operating assets. So that is 1 million divided by 2.8 million, which gives you 35.7%. That's also just all given in the question. All right. So then the last problem is the net present value. So Mayberry Textiles is considering the purchase of a new machine, which has an initial cost of $400,000. The annual operating cash inflows are expected to be $100,000 each year for 8 years. The salvage value is expected at the end of the asset's life, and the cost of capital is 14%. So to set this up, I'm just going to do a little table. So it's cash flow, and then your year, and the amount, and the factor of 14%, and then the present value. So to start, your cash flow is going to be the initial investment. Then the year is the present. So what you always start with is the first one. Your amount for this one is going to be $400,000, which is right here, the initial cost. Your 14% factor, since it's in the present, it's just going to be 1. So then your present value, you would just take the 400,000 times the 1, which is just the 400,000. Okay. And then you're going to take the annual inflows after that. So then since you already did the present, you're going to do 1 through 8 now. So that's for each year for 8 years. And then this amount is 100,000, which is given right here. Your factor is going to be 4.6389, and this is found by using the table. So on here, this is the present value of annuity of $1 table. So since it's a 14% factor, you use this 14%. And then since it's for 8 years, you're just gonna go down for 8, and the 14, that gives you 4.639. And then you just multiply that, and you get 463,890. And then you just take the difference of those, and that gives you 63,890. And that is going to be your answer for the net present value. And then based on your analysis, should they purchase the new machine? So since it is positive, you would purchase it. So positive, purchase it. All right, so that is all for the practice exam. If you guys have any questions, or if you guys want this sent to you, either a blank copy, which I believe is up there already, or if you want the copy with this, you can as well. And then if you have any questions, you can stop by my office hours and just let me know. And I hope you guys all have a great rest of your day. And good luck.